Moneysense, bringing an informed financial perspective to the Cayman community.
Good morning and welcome to Moneysense. I'm your host, Neville Hicks, alongside co-host Christoph Barnett. Good morning. And we've got Georgie Loxton in with us again. Georgie's, this is her second time on the show.
It is indeed.
Georgie is a specialist in financial planning and retirement planning, so it's an absolute pleasure to have you on the show. Welcome.
Thanks, Neville.
And we're going to be kind of kicking it back to basics. We've had a couple diverse shows speaking about particular asset classes in the past couple weeks. This show we're gonna kind of get back to the roots of what is financial planning, what do people need to consider, kind of some constraints and the appropriate time horizon that people should be conscious about. So, I guess with that, Georgie, what in a general sense, when you think of financial planning, what as far as a listener goes, what are some things they should be considering?
Well, I think financial planning encompasses your whole lifestyle, really. There's so many different things that come into it. You've got to start looking at your future. What do you want from your future? What are your lifestyle expectations? When do you want to stop working? What do you want that next phase of your life to look like? I think in Cayman it's really difficult because people often don't actually know the answer to that question. Often the expats don't actually know where they want to be. They don't know whether Cayman's going to be where they're going to retire or they're going to go elsewhere. So actually working out what you need in retirement is really hard for people here. But I think that's the first thing, to try and actually get a grip as to what kind of future you want. And then you've got to, go back to basics and look at where you are today. You've got to look at your assets. You've got to look at your liabilities. You've got to look at your pension plan. You've got to look at, things like, do you have any credit card debt? Are you paying, 15, 16% interest rates on your credit card debt? Do you have your emergency cash savings? That's really important because, I tell people all the time that, cash is a lousy investment in many ways. We're not going to make any money from cash. You're just losing to inflation every year. And, a modest 3% inflation over the next 25 years with zero interest rates, and your money's effectively halved.
Absolutely.
But you've got to have cash. Everyone has to have some cash sitting in the bank for those emergency, rainy day things that come up. Your car breaks down, or you fall sick, or one of your children falls sick. So I always tell people, look, if you've got credit card debt, get rid of that first.
Absolutely. Okay.
Then,
I guess because you're paying a higher rate of interest, right?
You could invest your money, but you're probably almost certainly not going to make
18%
per annum on your investment, but you're paying that on your debt. Low interest rate mortgages and things like that are totally different. But the car loans, they come into that. They're much higher rate of interest. And then get your emergency cash savings up. Try and get to 6 months, maybe 9 months worth of living expenses in a bank, in a savings account, or, if you can open a credit union account, even better, where it's sat there and it's just going to sit there for those rainy day expenses. And then you can start thinking about your long-term plan and start looking at what you have left at the end of every month. And if you don't have anything left at the end of every month, that's when you need to go back to some serious budgeting and try and, work out how you can have something left. And then you need to try and put something aside every month, right, for the future.
So assuming that my credit card debt is paid off, which it's not, and I've got my cash savings allotted, and let's say I'm 40. What, people often say, what is the retirement age? I guess that depends when I want to retire, how much I need to save. How do people, it seems such a daunting task, or it seems like it's so far away that it's hard to fathom it or hard to picture it. So how do you kind of get across to your clients or the people you deal with? Is it just saving on a monthly basis? Should they be, if they get a raise, should they be pocketing more? Is there kind of tips that you could...
That's a really important thing. There's this issue called lifestyle creep, where as we earn more money, we just improve our lifestyle. We eat at nicer restaurants, we buy a nicer car, et cetera, whereas if you every time you get a raise, you really diligently make sure that, say, half of your raise goes into the future, i.e. goes into a savings plan, that's going to make a really big difference to you in the long term. But I think one thing that I always try and make people understand is the power of compounding. And Einstein was a very clever man, and his quote about the power of compounding is that it was the seventh or eighth wonder of the world. And he said, he who understands it earns it, and he who doesn't pays it. So if you understand the power of compounding, or you can have someone explain that to you, you understand how your time horizon really, really matters. And every extra year that your money sits there compounding for makes a huge difference, especially as you get, 15, 20, 25, 30 years into the future, and your pot gets bigger and you compound that bigger amount. So the earlier you can start something, the better. But 40, you've still probably got a 25 year time horizon, which is a long time. You can do a lot in 25 years.
That's good.
Yeah.
Good news.
So absolutely, the earlier the better. And unfortunately, we can't go back. So the earliest is now. Now, just getting back to the savings, because it's something that we just say, and we say, oh, let's budget. But then people, we live in the real world, and people have real lives and real budgets and real expenses. And so it's not that easy when we come down and we say, oh, well, you should save 5, 10, 15% of your income. Some people hear that and say, there's absolutely no way. And now, usually there is a way, and it's just, we like our lifestyles and don't necessarily want to give up, one night of drinking, maybe a month or whatever it is, our guilty pleasures. But getting to the point of what Georgie was saying about saving when there is an opportunity, when there is a raise. There's a very successful program. It's been implemented in the U.S. and I think in the U.K. called Save More Tomorrow. So if I'm sitting down with someone and I say, okay, what can you save now? And we sort of go through that, and I say, okay, well, can you commit when you get a raise to have that? Let's say the raise is 3%. Will 1% of that? Can you commit 1% of that to savings? Because maybe then the saving rate goes from 5% to 6%. Next raise, 6% to 7%, and so on. If you do that every raise, within a few years, you can get up past that 10% mark. And it doesn't feel like pain because you're not giving up something you're already doing. You
don't have that daunting, you're not sacrificing something that you're already doing. Yeah.
Absolutely. It's a staircase, right? And, I never sit down with anyone who can do today exactly what is needed. But most people can do something today. And as you say, as time goes on, you do a little bit more, and you get closer and closer to where you want to be.
Absolutely. So, excuse me. So with that, I guess retirement age and consideration needs to be taken into account, because all of a sudden when you're retired, you're not earning any more income. You got to rely on your retirement savings. And a portion of that is, how long do you live? Because you need to live off that money that you save for retirement. I think the life expectancy now, I don't know exactly, but it's probably late 80s.
Yeah, high 80s.
High 80s. Yeah. I think women live longer than men.
Yeah, the retirement crisis is a massive gender issue, because women have a much bigger problem ahead of them than men do, because we live longer. We're likely to be the ones that are left maybe for another 5 years when our husbands have passed away, and our working careers tend to be shorter because we take time out to care for family members. Absolutely. For our children. Often, actually nowadays, women are taking time out later on in life to care for their parents or their parents-in-law. That role falls often on the daughters. So there's been a lot of studies and statistics out at the moment about how that very high percentage of women falling out of work and retiring early to care for their parents, and that obviously decreases what they have. So the shortfall for women at retirement is much, much higher than the shortfall for men.
That's definitely something to consider, though, too, when you're thinking about long term and the amount you should be saving. I guess, it's interesting to think about where we are, too, with the general markets and kind of asset allocation. So if I get to a point where I've paid off my credit card debt, I've got some cash savings, I've got a long-term investment horizon, what should I be investing in, or what are some options that I could look to as far as the various assets, whether it be stocks or bonds or alternatives or real estate?
Well, we can sort of go through the basic list. You touched on the two main ones, which are stock and bonds. So stock is equity, it's ownership in companies, whether it's your own business, which would be included in equity, or businesses that have gone public, meaning that the general public can buy shares on publicly traded exchanges. Those tend to be the most risky but generate the highest return. So, for example, in the U.S., the long-term return from stocks have been 7 or 8% a year. Now, unfortunately, we can't just put our money in there and say, oh, we're going to make an automatic 7, 8% because the volatility that comes along with that. And so you have actually most years aren't even close to the 7 or 8%. What you have is 1 year will be 20% and 1 year will be 2% and 1 year will be 15% and then 20% down. And it all averages out. So it's important their time horizon that you mentioned, Neville, is very important because with stocks, in fact, the longer you hold them, your risk actually goes down because of time horizon and because you tend to earn the long-term average. The volatility over a long period of time is smaller than just, say, for 1 year. So if someone has 1 year to retirement, should they be 100% in stocks? Probably not. But if they have 5, 10 years, 20 years, there's been I don't know if has there been any 20-year period with the down market?
There's not one 20-year period from the S&P 500 when you were down. Even if you invested right before the Great Depression, 20 years later, you were pretty much even. You hadn't actually lost money. Yep. And that's looking at every monthly rolling period from 1926 through till today.
That's very powerful. And then the other asset class, which is bigger, is bonds, which is debt. So that's where you've lent money to companies and governments and other organizations. And so you earn a fixed rate of return, and that's why they're often called fixed income investing. Now, in the last 30 years, we've seen interest rates come way down, and so right now we have the short-term rate at near zero. For 10 years, you make 2.5%. So it's
not terribly attractive.
Absolutely. So that's part of the
and
issue
in many
we're
places,
facing.
It's negative, right? I mean, you look at the European bond yields, and they're negative.
So those are the main asset classes. Other asset classes, real estate, what you said. So you can either join a pool and earn rental income and maybe property appreciation, or people locally invest in real estate themselves and rent it out. And you can make maybe a little bit more money because it's all yours minus the maintenance costs. And other alternatives, I guess, would be some hedge funds or just other trading vehicles. But those would be the main ones.
And so I guess getting back to more local Cayman pension requirements, can people, I mean, if they're investing in a pension, obviously there's a matching requirement from employers.
5% and 5%.
5% and 5%. Georgie, do you think this isn't enough to get people across the line, or is this something that
I think
people should be strongly considering adding additional to?
Absolutely. In Cayman, there's a huge, huge problem. And the main problem is, I believe, this cap at $60,000. So when they say that you have to put in 5% of 5% of your earnings, they describe earnings as $60,000 a year. So if you're earning more than $60,000 a year, 10% of your salary is not going into your pension. If you're earning $120,000 a year, 5% of your salary is going into a pension. Now, Christoph touched earlier on, this figure, but generally advisors say that we should be trying to save 20% of our salary. So, here it's much, much lower than that. Now, if you were starting out today and you worked for the next 35 years in Cayman and you did what was required, and that would be 500 CI a month going into your Cayman pension plan. Now, if your Cayman pension plan grew for the next 35 years at 5% on average every year, you would end up with a pot of 568,000 CI dollars.
Okay.
And according to the rules on how you can access that money, you could take out 2.5% every 6 months or 5% per annum, and that will give you an income of 28,000 CI per annum in 35 years' time.
Okay. Now,
that has not taken inflation into account. So $28,000 in 35 years' time is not going to buy you what $28,000 buys you today.
So that's 2050 we're talking about.
Uh-huh.
Right. So $28,000 is what you're going to have
exactly
for the whole
per year.
Yeah. And it's probably, that amount is probably going to go down every year as your pot shrinks. The 5% that you can take out every year is 5% of what's left. So there's not many people, I don't think, that can survive on that. Take your healthcare costs into account, for example. You've got to fund your healthcare. So it's there's a huge, huge problem.
Which goes back to the point about saving more independently.
Thank you very much. We're going to take a short commercial break, and we've got some fantastic stuff coming up. So please stick with us.
This is
Moneysense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands and sponsored by One Trade X.
And now, more Money Sense.
Welcome back to Money Sense. I'm your host, Neville Hicks, along with Christoph Barnett, and in studio with our guest today, Georgie Loxton. We've talked a little bit about the basics of financial planning, some of the constraints, the retirement age, life expectancy, savings, and we were just touching on pension and whether it's enough savings for people to properly retire on. And I think what we determined is basically in a nutshell, if you were to just adhere to the basic requirements as they stand right now, you would be looking over a significant time horizon. You would be looking at probably $28,000 a year when you retire. Is that correct, Georgie? Am I summarizing that relatively?
Yeah,
very high level, but
yeah, using back of envelope
an envelope calculation.
Yeah.
I think what it really kind of opens our eyes to is the fact that unless we want to be, it's possible to live off of $28,000 a year when you retire. You need to be thinking about additional savings and additional investment. And I think we're, just touching on that, we spoke a little bit about equities. We spoke a little bit about bonds and fixed income. What is the appropriate investment if you do have a long-term time horizon and you can kind of withstand some volatility?
Well, I certainly think it's equities because, today we're in uncharted territory, really, in terms of, the global economy with interest rates where they are and how long they've been very low, and they're likely to stay low for, an extended period of time. We've had quantitative easing. We've had so many different things go on. And I think that leads most people to believe that the return from bonds is certainly not going to be what it has been historically. Now, as Christoph said, we do have to remember that equities are the higher risk asset class. They're higher risk, but they're higher return. Now, I really try and explain risk to people. And academically, risk is volatility. It's how much something goes up and down around an average, basically. But when we're talking about retirement, I think that we need to think about risk in a completely different way. And to me, when you're talking about retiring in 20 years or 10 years or 40 years or however many years it is, the risk for you is the risk that when you get to retirement, you do not have enough money and it runs out on you when you're 85 or you're 90 or however
which
old,
would not
right?
be good.
That is the risk. Now, the less risk you take on in your investing life along the way, the higher the risk that you're not going to have enough money to retire on, because you'll have put your money into lower risk assets and your return will have been lower. Hence, the money that you have at the end will be less. So actually taking on less risk in a retirement scenario, I think actually increases your risk.
Can be more detrimental.
Exactly.
In the long term.
So I think it is very, very important that people understand that. And people, naturally can be quite risk averse. And it's definitely something with women. Actually, women have been shown to be less risk averse. And this actually compounds their problem of retiring with, way less money than men do. So I think, having someone to hold your hand and explain risk to you and understand that, yes, there will be volatility along the way, absolutely. But if you have a regular savings plan in place whereby you are investing in equities either on a monthly basis, a quarterly basis, a 6-monthly basis, however it is, however it works for you, the volatility doesn't matter along the way. What matters is where you are when you retire. What matters is how big that pot is.
So not to focus on the monthly returns,
Absolutely.
Not to get your pension or be checking your pension or your savings plan or your investment plan on a monthly basis, but really kind of focus on the long term and probably know that if some of your asset allocation or a lot of it is in equities, that there's going to be ups and downs. And I think maybe Christoph can, it all sounds very easy. That sounds very easy, and it's, but I think the inherent human biases kind of come into play, and I think that historically has been one of the issues with investing, right? Is people's emotions, people's behaviors. So if it was as easy as that, which it does sound relatively easy.
It can be, though, Neville, if you have a disciplined structure in place that enables you to ride out that volatility. And, there's a very famous investor called Peter Lynch, and he has a nice quote that said, the trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them.
Right.
And if you have a structure in place that enables you to ignore, those, as you say, those emotional feelings of feeling like you're losing money, then you can forget about it.
Because I think, and Christoph, you would know this better than me, but I think what's been the biggest drawdown in the equity market in the last, or over 2008, was it 50?
It depends on the market, but in the U.S., I think it was 57%
So
from high to low.
So 57%. So imagine you had $100,000 that was invested, and then all of a sudden you were sitting on
43,000, yeah.
Now, I wouldn't be happy. So, Georgie, you talk about discipline. How, what are some of these? I mean, there were a lot of people who had investments who, who capitulated and eventually ended up saying, I can't handle this. And so what causes that? Even though if it long term, that over 20 years that money will grow back, you have that time horizon, what causes people to panic?
So a tremendous amount of research in the last 30 years has been done on human behavior and how it affects our investments in finance. And if we just play a quick mental game where if I come to you and say, we're just going to flip a coin, 50-50 chance, if it's tails, you lose $10, and say, okay, how much do you have to win on heads to play that game? Now, different people have different amounts in their head, but a normal answer is something like $20. So people want twice as much gain to make up for that loss, when the rational choice is anything above $10 on the heads makes it a good game to play. And the conclusions that are reached from that and all other types of research is that people tend to feel losses twice as hard as the pleasure that they get from a gain. So if you lose $10, it feels the equivalently bad as if you win $20.
Okay.
Now what happens is if you have a 50% decline in the stock market, that means it feels like you've lost it all. And so that triggers a panic feeling and say, I lost all my money. I have to sell. I have to get out now.
Because you don't want to lose any more.
Yes,
I guess,
you felt
right?
like you've lost everything. You're in a panic mode, and that's why a plan is important. So there's these biases, but the plan counters these biases.
Especially if your plan involves you to be regularly buying equities, because during that 50% fall, you were buying all the way down.
Mm-hmm.
So
and it feels good to buy when
and
it's
that's
very
brilliant.
cheap.
That they're the units that you've bought right down the bottom there, that are the ones that are going to make you a lot of money over the long term. So stock market's falling when you're investing regularly. It's a great thing for the long term. It's not a great thing clearly if you're a year off retirement, but if you still have anywhere from 5 years, 10-year time horizon left in front of you, those falls are actually very beneficial, and it's very important that people can kind of get their head around that and understand that volatility is their friend.
Mm-hmm. That's an interesting way to put it. I mean, I think we can all relate to probably two of the biggest behavioral or emotional feelings that we have, which is fear and greed, and I think that drives a lot of the direction of the stock market and the reaction to the stock market in the short term. What was it that Warren Buffett says? Is, buy when people are fearful, or buy when people are
buy when people are fearful and sell when people are greedy.
So.
Yeah. And people instinctively want to do the complete opposite, and that's the herding bias, where everybody wants to do what everybody else is doing. And there's an old adage in the industry that when you get into your taxi and your taxi driver starts telling you about the next hot stock that you've got to be buying, that is absolutely the time to get out.
Right. That's the time to think about selling.
Yeah, because that's when every man on the street, wants to buy equities because they've gone up, a lot in the recent history.
And just getting back to the plan and our asset allocation and what's appropriate, I think one bias that we should also be aware of is the mental accounting bias. So that's where we say, okay, well, I have this amount of money for this, and this amount of money I set aside for education, and this amount I set for my education, and then I have I have this rental property that I rent out, and that income I use just for vacations and so on. And so we put these things in our mind instead of looking at our total wealth as a whole, right? Our rental property is part of our asset allocation. It's part of the real estate class. So if we say, okay, we have real estate and we have bonds and stock, well, maybe we say, oh, we need to buy more real estate because we want more of that vacation money because that's where it is in that mental account. When maybe that might cause us to have too much real estate in our total wealth, our total asset allocation. Now, it's also important to combine our liabilities. Georgie touched on that at the beginning, but our liabilities at the beginning, that's part of the total wealth too. Don't put that in a separate mental bucket either.
Right. Because I guess, in the real estate senses, you might have a real estate asset that generates income, but there might be a large debt associated with that. So you can't kind of compartmentalize those various aspects. I think it's interesting we talk about real estate because I think that's obviously a topic that we've spoke about here. It's a topic that affects Cayman a lot. I've heard this saying, well, my retirement is my home, or I own land and that's going to be my retirement. Why, is that a good plan? Is that, should other considerations be given, or is that, what are your thoughts to that?
I think it's part of the plan, Neville. I think there's a place for real estate, absolutely. But I think there has to be a strategy for converting your assets into income, right?
And I guess liquidity too.
Absolutely.
I mean, your real estate assets aren't necessarily
They're not liquid. And there's a danger of being asset rich and cash poor.
Right, absolutely.
So I think the important thing is to have a plan, have the advisor as part of that plan, whether it's a professional advisor or a friend that can help you stick to the plan to avoid these biases that we talk about, give you discipline, focus on costs, fees matter. Yeah, but absolutely. I think those are the key takeaways.
Anything else you'd like to add there, Georgie? We got one more minute here.
I just agree with Christoph. Have a plan. Find yourself an advisor that you trust who can help you and is going to be there along the way to hold your hand and prevent you from doing the absolute worst thing of capitulating at the bottom.
Right, absolutely. Well, I think that was some great points. Georgie, thank you for joining us on the show.
Thanks,
Christoph, as always. Thanks to the listeners. If you have any questions, please let us know. And we look forward to being on air again in 2 weeks. Thank you.
Thank you.